Hey everybody, there are still some good bargains in the stock market, especially now. The stock market, the S&P 500 and Nasdaq are no longer at all-time highs. They've fallen quite a bit from where they were through economic fears, tariff concerns, things like that. And some of the dividend stocks that I've had my eye on, dividend stocks had been cheap, relatively to the overall market for some time, but that's gotten even more so in a lot of cases. So I'm going to talk about some of my favorite dividend stocks to buy right now. Before I do that, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. So I'm going to share my screen real quick and talk about the 5 dividend stocks that I think are great buys right now. So the headline is dividend stocks are still cheap. The high interest rate environment has caused several sectors to remain depressed. A lot of those are dividend paying. Real estate stocks, financial stocks are 2 big examples. And many of these are cheap as we head into March. That's even more so now that tariffs have officially gone into effect. But we're seeing generally soft economic data, and it's kind of created a nice environment if you are a long-term investor looking for bargains. So without further delay, number one, and I've talked about this one a few times lately, and I've recently bought it for my own portfolio, SiriusXM, ticker symbol SIRI. It pays almost 5%. For most people, this doesn't need much of an introduction. They are the leading satellite radio company. They have the streaming radio service Pandora as part of their ecosystem. They trade very, very cheaply for a reason. The company hasn't really been able to grow in the past few years. Its user base peaked in 2019, and it's still below that right now. But there's a lot to like about this. For one, it trades for just 7.5 times forward earnings. So even without a ton of growth, it's still a very cheap stock. It's a very profitable company, done a great job with cost savings. They could be a big beneficiary of falling interest rates, which, where the market's currently pricing in about 4 rate cuts in 2025. That's more than originally expected. That could be a boost for the new car market as financing costs go down. There's a lot of growth initiatives. The ad platform is one of them. They're doing a prepaid 3-year dealer sold subscription product that could help boost their membership. It's actually a really good deal, so a lot of people might buy that. They're doing a lot of ways to kind of grow their subscriber base finally. And if they're successful in management's efforts to do this, it could be a bargain at the current price. Number 2, one that I've bought significantly a lot more of recently is the Vanguard Real Estate ETF, ticker symbol VNQ. Pays about 3.6%. This is an exchange-traded fund or ETF. It tracks real estate investment trusts. It's a weighted index, so it's more concentrated in the larger REITs. Prologis is one example, Equinix, and things like that. So real estate is the most rate-sensitive sector in the market. I can see it getting some nice tailwinds as rates fall. The businesses in the sector are generally doing well. They're built for steady income no matter what the market's doing. But, right now they're just kind of beaten down. So I think this could be one of the better performing sectors. At the beginning of this year, one of my bold predictions in my annual bold predictions article was that real estate will be the best performing S&P sector. And I think it has a good shot. Realty Income, one, if you want one within the real estate sector that I think is a particularly good buy right now, Realty Income, ticker symbol is just O. 5.5% dividend yield. It pays monthly, if that helps. They focus on single tenant properties. They have about 15,500 properties, most of which are retail in nature, but things like drugstores, convenience stores, things that aren't very recession resistant, don't really compete with e-commerce all that much. And if you look at that last bullet, they've grown their earnings, or funds from operations, which is the real estate version of earnings. They've grown their earnings by about 20% since 2020. And in that time, the stock is down by about 35%, despite the business still doing very, very well. Occupancy is still high. They're still finding ways to grow, just a function of interest rate headwinds. So one that I think is a really good buy right now. If in the financial space, Ally Financial is one that I've added to recently. Ticker symbol is ALLY, 3.4% dividend yield. If you bought a car, you might be in the past few years, you might be very familiar with them. They are the leading non-subprime auto lender. or a non-dealer or non-manufacturer-owned auto lender that is in the United States. They used to be a part of General Motors. They were spun out after the financial crisis when GM went bankrupt. Um, but they've kind of grown and evolved into a big online bank. They have well over $100 billion of consumer deposits. They still focus on auto lending, and now they're renewing their focus on auto lending. They announced that they're getting out of the credit card and mortgage businesses to really double down on what they do the best. Really excited to see that. The margins on their auto loan business are excellent and could get even better as rates fall. And they trade for less than 10 times forward earnings right now. So right now could be a really good opportunity to add shares of Ally. All right. Last but certainly not least, and one that I just recently bought some more of, Walker and Dunlop, ticker symbol is WD. I did an interview with their CEO Willie Walker last year, so check that out if you haven't already. It's on this it's on this channel. You may have to hunt for it. I'll try to post the link. But this one just hit a new 52-week low, and they are a commercial real estate finance company. They do a few different things in commercial real estate. They originate loans, they service loans, they have a property sales division. They have a real estate investment banking division. They do a lot of different things in commercial real estate finance, and the commercial real estate market has just been terrible lately. So the stock's been beaten down due to the stagnant market. It has a great track record of growing its market share over time. I don't see that changing anytime soon. I mentioned that my interview with Willie Walker, he's a fantastic manager and is the grandson of the co-founder. This business has been around since the 1930s. So really great opportunity. Still a pretty small company, but they want to kind of grow into the leader in commercial real estate finance. They're not quite there yet. They are a leading multifamily lender, but when it comes to other types of commercial real estate, they're still rather small. Really interesting business, and one that I am really excited to see where it goes once the market starts to turn around. So which of those five do you like? I own all five of those in my own portfolio. I'm putting my money where my mouth is with those. I'll do my best to respond to any questions or comments you have individually, and thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.